Wall Street is quietly moving hundreds of millions of dollars into XRP right now. Not retail traders, not crypto influencers on X pretending they predicted everything. Real institutional money. And the strange part, the biggest corporate XRP holder on Earth is currently sitting on a brutal paper loss approaching $500 million. Most people look at that number and immediately think one thing: disaster, failure, bad timing, a catastrophic trade. But the people actually making these moves? The institutions absorbing massive amounts of XRP while social media argues over daily candles? They see something completely different. Because this is not how panic looks. This is how conviction looks before the public finally understands the game. And that's what makes this moment so uncomfortable. See, retail investors are conditioned to believe smart money always buys the exact bottom. They imagine Wall Street entering perfectly, catching every cycle low, never feeling pain, never sitting underwater. Reality is much uglier than that. The biggest institutional positions in history almost always looked stupid in the beginning. Michael Saylor looked insane buying Bitcoin while it was collapsing. Amazon looked dead during the dot-com crash. Nvidia looked overpriced before AI exploded into the mainstream. The public only calls it genius after the move works. Before that, they call it reckless. And right now, XRP is sitting directly inside that psychological battlefield. Because while retail traders stare at price action every 5 minutes hoping for instant validation, institutions appear to be positioning for something much larger, something slower, something structural, something that feels less like a crypto trade and more like a transition in financial infrastructure itself. That's the part most people still don't fully understand. This isn't just about whether XRP goes up next week. This is about whether global finance is quietly moving toward a completely different settlement system underneath the surface while the public remains distracted by volatility. And if that sounds dramatic, look at the numbers. One firm alone has accumulated hundreds of millions of XRP tokens despite being massively underwater on the position. Not trimming, not reducing exposure, not panic selling, holding, actually increasing conviction while the market stays uncertain. That behavior tells you something extremely important. Institutions do not tolerate losses emotionally the way retail traders do. They tolerate losses strategically. There's a difference. Retail investors experience red candles like emotional attacks. Every dip feels personal. Every correction feels like failure. Every negative headline creates fear. Institutions think differently. They ask one question: has the long-term thesis changed? If the answer is no, temporary pain becomes irrelevant. And right now, the firms accumulating XRP appear to believe the long-term thesis is becoming stronger, not weaker. That's why this moment matters so much. Because beneath the noise, something unusual is happening across the entire digital asset market. Ownership is changing hands. Quietly, systematically, emotionally exhausted retail investors are handing supply over to entities with longer time horizons, deeper pockets, and far more patience. And historically, that transfer phase is where the largest wealth shifts begin. Not when everybody is euphoric. Not when CNBC tells you it's safe. Not when your Uber driver starts giving crypto advice. It happens during boredom, during frustration, during disbelief, during periods where price action intentionally shakes people out emotionally. That's why so many retail traders struggle to survive long enough to catch major moves. Because psychologically, humans are wired to seek immediate reward. Institutions exploit that weakness. They know most people cannot sit through uncertainty. They know most investors eventually break emotionally after enough sideways action. And they use that exhaustion to accumulate. That's what makes the current XRP setup so fascinating. Because underneath the surface, there are signs that large players are thinking years ahead while most traders are still trapped inside hourly candles. Look at the broader backdrop. The legal cloud that haunted XRP for years is finally fading. Spot ETF conversations are no longer fantasy. Major financial entities are now openly discussing tokenization, cross-border settlement efficiency, and blockchain infrastructure in ways that would have sounded ridiculous just a few years ago. The conversation itself has changed. That matters more than most people realize. Markets move in narratives long before they move permanently in price. First, the idea sounds stupid, then controversial, then possible, then obvious, and once something becomes obvious, the biggest money has usually already positioned itself. That's why this period feels so psychologically difficult, because XRP exists in a strange middle zone right now. It's no longer dismissed the way it once was, but it also hasn't reached full institutional normalization yet. And those transition periods are where uncertainty becomes emotionally violent. One day the market screams that XRP is dead. The next day institutions file ETF products tied to it. One week people claim utility doesn't matter. The next week, major financial players discuss tokenized settlement infrastructure. One month, retail loses confidence. The next month, whales quietly accumulate record amounts of supply. That contradiction creates confusion, and confusion creates opportunity, because most investors cannot operate clearly inside uncertainty. They need consensus. They need emotional safety. They need everybody else to agree before they feel comfortable. But institutional positioning rarely happens after certainty arrives. It happens before. That's why this current environment feels almost designed to wear people down psychologically. You can see it happening in real time. Retail traders obsess over short-term volatility, while institutional narratives continue expanding quietly underneath the market. Tokenization, cross-border liquidity, stablecoin infrastructure, real-world assets, settlement modernization. These aren't meme narratives anymore. They're becoming actual conversations inside traditional finance, and that changes the entire emotional framework around XRP, because suddenly the question shifts from, can XRP pump? To, what happens if XRP becomes part of the infrastructure layer itself? Those are two completely different conversations. One is speculation, the other is adoption, and institutions care far more about infrastructure than hype. That's why the comparison to Michael Saylor keeps resurfacing. Not because XRP and Bitcoin are identical. They're not. But because the psychology surrounding large conviction positions looks eerily similar. When Saylor bought aggressively during uncertainty, people mocked him relentlessly. When Bitcoin crashed, critics celebrated. When MicroStrategy went deep underwater, the media treated it like financial suicide. But Saylor wasn't trading momentum. He was positioning for what he believed the future monetary system would eventually value. That distinction changed everything. And now, some institutional XRP holders appear to be operating with that exact same mindset. Not chasing short-term candles, not reacting emotionally, not panicking during red weeks, thinking structurally, thinking in years, thinking about where global liquidity systems could evolve next, and whether XRP ends up winning that race or not. The scale of conviction being shown right now is impossible to ignore, because normal investors do not casually tolerate half-billion-dollar drawdowns, especially not publicly. That only happens when the people involved believe the future upside is dramatically larger than the current pain. And that's where this story becomes dangerous. Because if institutions are right, most retail investors are still massively underestimating what's actually happening beneath the surface of this market. The strangest part about this entire XRP story isn't the price action, it's the timing. Because while most retail investors are emotionally exhausted, institutions are acting like the real game is only just beginning. And that disconnect should make you pause for a second. Because markets become extremely dangerous when the public and smart money are seeing completely different realities at the same time. Right now, most retail traders look at XRP and see frustration, years of sideways movement, legal drama, volatility, false starts, missed expectations. But institutions, they appear to be looking at infrastructure. That's a completely different lens. And once you understand that difference, the behavior suddenly starts making a lot more sense. See, retail traders are trained to think in price. Institutions think in systems. Retail asks, will this go up next month? Institutions ask, what role could this play if the financial system evolves in this direction over the next decade? That mindset shift changes everything, because suddenly, short-term pain becomes almost irrelevant compared to long-term positioning. And that's exactly why some of the largest players in the market seem completely unbothered by massive unrealized losses right now. They're not staring at candles. They're staring at adoption curves, settlement systems, liquidity networks, tokenization infrastructure, cross-border efficiency, and more importantly, they're staring at where traditional finance appears to be heading whether the public realizes it or not. That's the real story underneath all of this, because something very unusual has started happening over the last few years. Traditional finance stopped laughing at blockchain infrastructure, quietly, without fanfare, without the media making a huge scene about it. The tone changed. Banks that once dismissed digital assets started experimenting with tokenization. Asset managers started filing crypto-related products. Financial giants began discussing blockchain settlement efficiency openly. And suddenly the conversation shifted away from speculation toward infrastructure modernization. That transition matters more than almost any short-term price movement. Because once institutions start treating blockchain technology like infrastructure instead of a temporary trend, capital behaves differently, much differently. It becomes slower, more strategic, more patient. That's why this current XRP positioning phase feels so important psychologically. Because institutions don't appear to be chasing hype, they appear to be building exposure before broader financial integration potentially accelerates. And one of the clearest signals of that shift came after the legal uncertainty surrounding XRP finally started clearing up. For years, that lawsuit acted like a psychological ceiling over the asset. Even people bullish on XRP knew the legal cloud created hesitation. Institutions hate uncertainty, especially regulatory uncertainty, but once legal clarity started emerging, something changed. The floodgates didn't explode open overnight. That's not how institutional money moves. Instead, positioning started quietly expanding beneath the surface. ETF discussions intensified. Major firms began exploring exposure. And suddenly, XRP stopped looking like a permanently isolated asset and started looking like a potential piece of future financial plumbing. That phrase matters. Financial plumbing? Because the biggest money in the world does not care about memes. It cares about systems that move value efficiently, quietly, reliably. At scale, that's where the XRP narrative becomes extremely interesting. Because while retail investors debate daily price action, institutions may be evaluating whether XRP can function as a bridge layer inside a tokenized financial world. And if that sounds overly ambitious, look at what's already happening across global finance. Tokenized treasuries are growing rapidly. Real-world asset tokenization is accelerating. Stablecoin adoption continues expanding globally. Cross-border payment systems are modernizing. Governments are actively exploring digital financial infrastructure. This isn't theoretical anymore. It's happening slowly, quietly, and institutions know infrastructure transitions create enormous wealth shifts, especially when the public underestimates them early. That's why so much smart money appears obsessed with accumulation during periods of weakness rather than excitement, because they understand something most retail traders emotionally struggle with. The best asymmetric opportunities rarely feel comfortable in real time. They feel frustrating, confusing, emotionally draining, and XRP has become one of the most emotionally exhausting assets in the entire crypto market. That exhaustion itself may actually be part of the setup, because psychologically broken markets create opportunity for entities capable of thinking longer term than everyone else. Look at what's happening with whale wallets. Accounts holding large amounts of XRP recently surged to record highs. That's not random. That's not noise. That's large-scale accumulation behavior during uncertainty. And historically, that pattern matters, because major market transitions often begin with silent ownership transfer phases. Weak hands sell emotionally. Strong hands absorb supply patiently. The public interprets sideways action as weakness, while institutions interpret it as opportunity. And here's the part most people miss. Institutions actually prefer boring price action during accumulation. They do not want explosive candles while building positions. That creates slippage, attention, FOMO, competition. Quiet markets are easier to absorb. That's why sophisticated buyers often use algorithmic accumulation strategies specifically designed to avoid drawing attention. They break orders into smaller pieces, spread buys across multiple exchanges, accumulate gradually, hide intent, because the last thing large players want is for the crowd to realize what's happening too early. And meanwhile, retail traders often do the exact opposite emotionally. They chase excitement, momentum, green candles, validation. They want movement first and conviction later. Institutions reverse that process. They build conviction first, then wait for the market narrative to catch up later. That difference creates enormous asymmetry, especially during transitional periods like this one, because XRP now sits at the intersection of several massive macro trends simultaneously. Digital settlement systems, real-world asset tokenization, institutional blockchain integration, stablecoin infrastructure, cross-border liquidity modernization. Those themes are becoming increasingly important globally, and institutions appear to be preparing accordingly. That's why the technical evolution of the XRP ledger matters so much right now. For years, critics argued XRP lacked programmability compared to ecosystems like Ethereum. But now the infrastructure itself is evolving. Smart escrow functionality, expanded institutional capabilities, EVM interoperability, new development flexibility. These upgrades may sound technical, but institutions care deeply about technical capability expansion, because infrastructure adoption requires flexibility, security, scalability, compliance compatibility. That's why institutional finance doesn't move quickly. It moves cautiously. But once infrastructure becomes trusted, capital flows can become enormous. And that's the psychological shift beginning to happen underneath this market. Not overnight hype, not meme frenzy. Infrastructure confidence. That's slower, but potentially much bigger. Because global finance is measured in trillions, not billions. And the firms positioning aggressively right now appear to believe XRP could eventually play a meaningful role inside that transition. Again, that doesn't guarantee success. Nothing is guaranteed in markets. But it does explain why some institutions seem perfectly willing to sit through extraordinary short-term pain. Because if they truly believe blockchain-based settlement infrastructure is coming, then current price action may look insignificant compared to the long-term prize. And that's where this becomes emotionally difficult for retail investors. Because holding through uncertainty requires conviction. Real conviction, not social media conviction. Not diamond hands memes, actual psychological endurance. The ability to remain calm while the market constantly tests your belief system emotionally. Most people fail that test. That's why institutional accumulation phases are so powerful historically, because they exploit human impatience directly. And right now, XRP may be sitting inside one of the largest patience tests in the entire digital asset market. There's another layer to this XRP story that most people still haven't fully processed yet. And honestly, it may be the biggest reason institutions appear so calm right now despite the volatility. Because this isn't only about crypto anymore, it's about tokenization. And tokenization could completely reshape how value moves across the global economy. That sounds dramatic at first, until you realize it's already happening, quietly, behind the scenes. While most people are still arguing about memes and daily candles, see, traditional finance has a massive problem most retail investors never think about. The global financial system is incredibly slow, painfully slow. Moving money across borders still feels like operating inside the early internet era. Settlement delays, intermediaries, counterparty risk, liquidity traps, massive fees, hidden friction everywhere. And institutions hate friction because friction costs money, huge money. That's why tokenization has become such an important conversation inside finance. Because once assets become tokenized, they become programmable, transferable instantly, tradable globally, fractionalized, and most importantly, they become dramatically more efficient to move. That's why large financial entities are suddenly paying attention. Not because blockchain is trendy, because efficiency compounds at institutional scale. Saving seconds matters when trillions move daily. Reducing settlement risk matters. Unlocking liquidity matters. Cross-border flexibility matters. And this is where XRP starts becoming extremely interesting to institutions. Because XRP was always designed around movement, liquidity, settlement, speed. That core identity suddenly matters much more in a tokenized financial world. And the numbers surrounding tokenized assets are already becoming difficult to ignore. Real-world asset activity on blockchain networks has exploded recently. Treasuries, funds, credit instruments, yield-bearing products. These are no longer hypothetical experiments. Large financial players are actively testing them now. That shift changes the emotional gravity around XRP completely, because suddenly the conversation evolves from speculative crypto hype into institutional settlement infrastructure, and institutions think in infrastructure cycles, not hype cycles. That distinction matters more than most people realize. Hype creates volatility. Infrastructure creates longevity. That's why some of the biggest firms in finance appear increasingly interested in blockchain rails capable of handling institutional-grade settlement requirements. Speed alone isn't enough. They need scalability, reliability, compliance compatibility, low transaction costs, security, liquidity depth. That's where XRP's positioning becomes extremely compelling for certain players, especially if tokenized finance continues accelerating over the next decade. And honestly, this may explain why institutions appear willing to absorb so much supply during periods of public doubt, because they may not be evaluating XRP through the lens of crypto investing anymore. They may be evaluating it through the lens of future settlement architecture. That's a very different framework psychologically, because infrastructure assets are valued differently than speculative assets. People don't obsess daily over the volatility of internet cables, or payment rails, or cloud infrastructure. The value emerges from usage, adoption, dependence, network effect. And that's exactly the type of long-term positioning some institutions appear to be betting on right now. Look at the rise of tokenized treasuries alone. Traditional financial products are increasingly moving on-chain because the efficiency gains are becoming impossible to ignore. Settlement in seconds instead of days, reduced friction, lower operational costs, faster global liquidity movement. Those advantages compound massively at institutional scale. And once institutions begin optimizing around efficiency, the transition can accelerate surprisingly fast. That's what happened with the internet. At first it seemed optional, then experimental, then inevitable. Financial infrastructure transitions often follow similar psychological patterns: slow disbelief, gradual experimentation, sudden acceleration. And some firms clearly believe XRP could become part of that acceleration phase. That's why the stablecoin conversation surrounding RLUSD matters so much. A lot of retail investors misunderstood that development initially. They assumed a Ripple-linked stablecoin somehow reduced XRP's relevance. But institutions may actually see the opposite, because stablecoins solve one problem, while bridge liquidity solves another. Stablecoins provide stability. Bridge assets provide movement. And in a global tokenized system, movement becomes incredibly important, especially when transferring value across currencies, jurisdictions, and asset types instantly. That's why some analysts describe the relationship almost like infrastructure layering. One component stabilizes value, another enables liquidity mobility. Together, they create a more functional system. Institutions understand ecosystem design deeply. That's why they rarely think in simplistic winner-takes-all narratives. They think in integrated systems. And the institutions accumulating XRP right now may believe the future financial ecosystem requires exactly that kind of integrated infrastructure. Again, none of this guarantees XRP dominates globally, but it absolutely explains why sophisticated players continue building exposure despite volatility. Because if tokenized finance truly scales globally, liquidity infrastructure becomes one of the most valuable layers in existence. That's not a small market. That's civilization-scale finance. And honestly, this is where most retail investors emotionally underestimate the situation completely. They still think like traders. Institutions are increasingly thinking like architects, builders, infrastructure allocators. That's why their behavior feels so strange during market weakness. Retail sees red candles and assumes failure. Institutions see discounted access to strategic positioning. And psychologically, that difference changes everything. Because retail traders need emotional confirmation constantly, institutions need thesis validation. Those are not the same thing. That's why large firms can remain calm through massive drawdowns if the broader infrastructure thesis continues strengthening underneath the surface. And right now, many signs suggest institutional blockchain infrastructure development is accelerating, not slowing down. Governments are exploring digital asset frameworks. Banks are testing tokenization systems. Major financial entities are building blockchain products quietly. Asset managers are preparing digital infrastructure exposure. The direction of travel is becoming increasingly clear, even if timelines remain uncertain. That's what makes this period so psychologically difficult for ordinary investors. Because infrastructure revolutions look messy in real time, there's confusion, volatility, contradiction, false starts, skepticism. But underneath the surface, the systems keep evolving anyway. And that's exactly what appears to be happening around XRP right now. The ledger itself continues evolving technically. Institutional integration discussions continue growing. Tokenized asset volume continues expanding. And meanwhile, large players continue accumulating despite enormous temporary pain. That combination is extremely unusual, especially because institutions are not known for emotional loyalty. They abandon failed narratives quickly. Capital is ruthless. If the thesis breaks, smart money leaves. The fact that large entities remain committed despite the volatility suggests they believe something much larger is unfolding beneath the short-term chaos. And maybe the most important part of all this is that most people still don't emotionally understand the scale of what tokenization could eventually become. We're not talking about meme coins. We're talking about transforming how ownership itself moves globally. Stocks, bonds, treasuries, real estate, commodities, funds, currencies, settlement systems, liquidity networks, all becoming faster, programmable, borderless, instant. That transition would create enormous demand for reliable liquidity infrastructure, which is exactly why certain institutions appear obsessed with positioning before broader public understanding arrives. Because once infrastructure adoption becomes obvious, pricing usually changes much faster than people expect. And by then, the easiest accumulation phase is already over. That's why this current environment feels so emotionally confusing. The market still looks uncertain on the surface, while institutions behave as if the long-term direction is becoming clearer internally. And historically, those moments tend to matter a lot more than people realize at the time.